All right, then next we need to calculate the weighted contribution per unit. All right, and we have two different products, jam and chutney. So we'll need to calculate the contribution per unit for each of those products. And remember, we calculate contribution by taking the selling price per unit, and we'll then deduct the variable cost per unit. All right, so first we're going to have to calculate the selling price per unit. So that's going to be calculation 3. Okay, if we just clean this up a bit. We've got the total sales value over here for each of the products in rands. And in note 1, we know that Jane expects to sell 39,600 jars of jam. So we can easily calculate the selling price per unit for jam by taking the total budgeted sales and dividing by 39,600 jars of jam. Then for chutney, first we're just going to have to multiply all of these probabilities out over here and calculate expected sales. Then once we have the expected sales, we can take the total rand value of sales, divide by the expected sales in units, and that will give us the budgeted selling price per unit. Okay, so let's first calculate the expected sales for chutney. Just by multiplying out all of those probabilities. So there's a 30% chance that she's going to sell 23,000 units. There is a 50% chance that she's going to sell 20,500 units. And there is a 20% chance she's going to sell 17,750 units. So if you multiply all of that out, it gives us expected sales of 20,700 units. So that's what we'll use as budgeted sales in all of our calculations. So we can then calculate the selling price per unit for each of the products. So for jam, just take the total budgeted sales value and divide by 39,600 units. So the budgeted selling price per unit is 60 Rand. And do exactly the same thing for chutney. Right, and that gives us 40 Rand per unit. Then next we need to deduct variable manufacturing overheads. So just as a reminder, these are your variable manufacturing overheads over here. So you'll remember we already calculated the fixed manufacturing overheads. So we need to work backwards. We need to take product costs, deduct the fixed overhead, and that will then leave us with our variable manufacturing overheads. Now, you just need to be careful, guys. You can't just take this total cost of sales figure over here, deduct the fixed manufacturing overhead to get the variable cost. There's two problems with that. Firstly, you're going to get the variable cost in total, and you're not going to know what portion relates to jam and what portion relates to chutney. So that's one problem. Then another problem is, please, and this is very important, this is cost of sales. It's not your total production costs. Here's your total production costs. In order to calculate cost of sales, we need to deduct closing inventory from our production costs. So be careful. You can't just use cost of sales. All right, now there's a few different ways that you can perform this calculation, and I'd like to show you the various different alternatives because it will definitely help with your understanding. However, obviously it's going to take a lot of time for me to write out all of the various alternatives. So what I'm going to do is I'm going to jump to the suggested solution and just talk you through the logic behind everything so that I can show you all the different alternatives and all of the different ways that you could have performed this calculation. All right, so what I want to do first is let's break cost of sales down into what it's made up of. We know that we calculate cost of sales by taking opening inventory, adding production costs, and deducting closing inventory. Let's get the breakdown of this calculation. All right, so I'm looking at the alternative calculation in the suggested solution. And like I just said, remember, we calculate cost of sales by taking opening inventory, we add production costs, and we deduct closing inventory. Now, we know that this is a new business, so like I already said, we don't have any opening inventory. Then we need to calculate production costs by working backwards. You've got cost of sales for both of the products, so that's the starting point in your calculation. Use the cost of sales figure. And remember, guys, the maths logic is you multiply by what you want and you divide by what you've got. So what do we want? We are trying to calculate production costs. So we need to multiply by 100. Divide by what you've got. What have we got over here? We've got cost of sales. So we're going to divide by 90%. So you multiply by 100 over 90, and that will give you the production cost for jam and the production cost for chutney. Then closing inventory is a very simple calculation because you were specifically told in the scenario that it is company policy to keep 10% of total units produced in inventory at the end of each year. So all you need to do is take the production cost and multiply by 10% for each of the products in order to calculate closing inventory. So now you have the production costs for each of the products. So remember, this production cost over here is a semi-variable cost. It includes a fixed portion and a variable portion. We've calculated the fixed portion. If we quickly go back to our calculations over here, there's your fixed product cost. We have the fixed portion. But the problem is we have the fixed portion in total. We don't know what portion of this cost relates to jam and what portion relates to chutney. So first, what we are going to have to do is split the fixed cost between the two products. Then once we've split the fixed cost between the two products, we can take the total product cost for each of the products, subtract the fixed portion, and you'll then be left with the variable portion. So how are we going to split the fixed production cost between the two different products? If you go back to the information provided in the scenario, you were told that fixed manufacturing overheads are allocated to products based on units manufactured. So you'll remember we said that means you are going to calculate the allocation rate by taking the budgeted fixed overhead. Now we already have the budgeted fixed overhead. There's the budgeted fixed overhead. And you need to divide by units manufactured. And remember, in terms of IAS 2, that should be normal capacity. But if normal capacity has not been given, you can use budgeted production. So in this question, normal capacity has not been given, so we are going to use budgeted production in the calculation. So we've got the budgeted fixed overhead, but we need to calculate budgeted production because we don't have budgeted production. All right, so let's just jump to calculation 6 over here in order to calculate budgeted production. All right, so based on the information provided in the scenario, we know that they budget to sell 39,600 units of jam, and by multiplying out all of the probabilities, we calculated that the expected sales for chutney is 20,700 units. So that comes from our previous calculation. Then remember, guys, this is a new business, so there won't be any units in opening inventory. So once again, we are going to have to work backwards by using the budgeted sales volumes to calculate budgeted production. And remember, guys, the logic is always you multiply by what you want and you divide by what you've got. We've got budgeted sales. We know that 10% of what they produce is going to be kept in closing inventory, which means they're only going to sell 90% of what they produce. So we've got 90%. And we're trying to calculate total production. We're trying to calculate the 100%. So you take the budgeted sales amount, You multiply by what you want. We want production, so multiply by 100 and divide by what you've got. We've got budgeted sales, so divide by 90. All right, we're applying the same logic that we did when we calculated product costs. You multiply by what you want. We want budgeted production, so we are going to multiply by 100, divide by what you've got. We've got budgeted sales, so divide by 90. All right, so that gives you budgeted production, and you can then obviously calculate the total budgeted production. It's your budgeted production for jam plus the budgeted production for chutney. That will give you total budgeted production. But while we are here, you can also complete this reconciliation. We know that 10% of what they produce will be kept in closing inventory. So 10% of production will be kept in closing inventory, and you can then see everything over here reconciles perfectly. All right, so remember the whole reason we calculated budgeted production over here is because we are trying to calculate the fixed overhead allocation rate. So you can see that calculation just above in calculation 5, where we are going to take this budgeted fixed production cost over here, because that's how we calculate our allocation rate, remember? We take the budgeted fixed overhead and we are going to divide by budgeted production. We're calculating this fixed overhead allocation rate. All right, so your budgeted fixed manufacturing overhead divided by budgeted production, which we just calculated over here, and that gives you your fixed overhead allocation rate. It's R11.32 per unit. Then, just take a step back. What are we trying to do over here? Why did we calculate this? Remember, guys, what we are trying to do is we've got the production costs for each of these products over here. So this is where I'm looking over here. We've got the production costs for jam and we've got the production costs for chutney. So what we're going to do is, that is a semi-variable cost. It includes a fixed portion and a variable portion. If we deduct the fixed portion, we'll be left with the variable portion. So first, I just want to look at option 2, because that follows on nicely from what we've just done. So you take that total semi-variable cost, which I have from above. You can see it's these amounts over here, the total semi-variable cost for each product. And remember, we said that's a semi-variable cost. If we deduct the fixed portion, we'll be left with the variable portion. So we know that the fixed overhead allocation rate is R11.32 per unit. So if we want the fixed cost in total for each of the products, we obviously just need to multiply by budgeted production. So once again, we have already performed this calculation. Budgeted production for jam is 44,000 units, and for chutney, it's 23,000 units. So take the fixed overhead per unit, multiply by the number of units. So you're taking the total cost, you're subtracting the fixed portion, and you are then obviously left with the variable portion. And obviously, guys, we need the variable cost per unit because we are trying to calculate over here contribution per unit. So we need this variable manufacturing overhead per unit. So in order to get the cost per unit, obviously, you need to divide by budgeted production, and that will give you the cost per unit. So that's one way that you can perform the calculation. I'm just going to now include this in our calculation over here. Sorry, so that is calculation 4. For jam, the cost is 35 Rand per unit, and for chutney, it is 25 Rand per unit. Now, there's a few different ways that you could have performed this calculation. I've shown you the one alternative. I just want to quickly cover the other alternatives with you. So in option 2, we performed the calculation in total. We took the total production cost for each of the products. We deducted the total fixed cost, and that left us with the total variable cost, and we had to divide by the number of units that they budget to produce in order to get the budgeted variable cost per unit. Instead of performing the calculation in total, you can also perform the calculation per unit. So what we need to do over here, if we're performing this calculation per unit, you need to take this total product cost that you have for each of the products, and you need to divide by budgeted production, because that will obviously then give you the product cost per unit. So take the total product cost, divide by budgeted production, which is in calculation 6, and you get the total product cost per unit for each of the products. So I'm saying this is the total product cost because this is a semi-variable cost. It includes a fixed portion and a variable portion. Then obviously, if you deduct the fixed portion, which we calculated in calculation 5 as 11 Rand 32, deduct the fixed portion and you'll be left with the variable manufacturing cost per unit. So obviously, that's another way that you could have performed the calculation. However, a much easier way that you could have performed this calculation, but it requires you to have a good understanding of what cost of sales is. Let's look at this calculation over here. In the question, you were given cost of sales for jam, and you were also given cost of sales for chutney. So if you want to calculate the product cost per unit, you can take cost of sales and you can divide by budgeted sales. Just be careful, guys. You are not dividing by budgeted production. You are using cost of sales in this calculation. So cost of sales is the cost of the units sold. So if you want the product cost per unit, you need to divide by budgeted sales and not budgeted production. The only time that you can divide by budgeted production is if you use product costs in your calculation. So if you use the production cost, then you divide by budgeted production to get the product cost per unit. But if you are using cost of sales instead of production costs, you then need to divide by budgeted sales in order to get the product cost per unit. And you can see you get exactly the same answer over there. And once you have that product cost per unit, you obviously just need to deduct the fixed portion because we know this is a semi-variable cost. It includes a fixed portion and a variable portion. So you deduct that fixed overhead cost per unit, which is 11 Rand 32. We performed that calculation in calculation 5. And once again, you're going to be left with the variable manufacturing cost per unit. So you can see this calculation is a lot easier because you didn't have to first calculate production costs. You were given cost of sales in the question. So you could just use cost of sales to perform the calculation. However, you'll see there's a bit of a discussion below over here. You can't always take this shortcut. I'm just going to quickly jump to Excel so that I can explain the logic behind what I've got in the notes over here so that you know exactly when you can use this shortcut and when you can't use this shortcut. All right, guys, so for the purposes of this discussion, I'm just looking at jam, but exactly the same logic would be applied for chutney. So first, guys, if we look at everything in Rand values over here, we know that there's nothing in opening inventory. We calculated those production costs, and we know that closing inventory is 10% of production. So you can see that over there. Cost of sales was given in the question, but if you look at the breakdown, we know that cost of sales is opening inventory plus production costs minus closing inventory. So you can see there everything reconciles perfectly. So that's dealing with all the Rand values. If we then look at the units, we know that there are no units in opening inventory. We calculated that budgeted production is 44,000 units. We know that 10% of the units produced will be kept in closing inventory. So that's how we calculate closing inventory. And we calculate budgeted sales by taking opening inventory, adding budgeted production, and deducting closing inventory. That gives us budgeted sales. So the two alternatives that we looked at is you could either calculate this product cost per unit by taking your product costs and dividing by budgeted production in units, or as an alternative, you can take cost of sales and divide by budgeted sales in units. And regardless of how you perform the calculation, you get 46 Rand and 32 cents as your product cost per unit. Now, the reason why we can take the shortcut and say cost of sales divided by budgeted sales to get the product cost per unit is because there is no opening inventory in this question. That's why this works out regardless of whether you use production costs or cost of sales. You just need to be careful when there is opening inventory in the question. So let's assume, for example, that there are 2,000 units sitting in opening inventory, but I want you to assume that your costs have not changed from the prior year to the current year. So in the prior year, your product costs were 46 Rand and 32 cents, exactly the same as what they are in the current year. So that means opening inventory would be 2,000 units multiplied by 46 Rand and 32 cents. Now, you can see again, if there is opening inventory, and if your product costs have not changed from the prior year to the current year. So remember, opening inventory that we are looking at over here, that's the prior year's closing inventory. So it's based on your prior year costs. So with all of the assumptions that I have over here, I'm assuming that my current year product costs are 46 Rand and 32 cents. And I'm assuming that the prior year product costs are also 46 Rand and 32 cents. There's been no change in product cost from last year. That's last year's product cost. That's this year's product cost. There's been no change in my product cost from last year to this year. So because there's been no change in the cost, I can still use the shortcut, and you can see we come back to exactly the same answer, 46 Rand and 32 cents. The problem comes in, guys, is usually your product costs don't stay constant from one year to the next. Usually your costs are going to increase from one year to the next. So let's assume, for example, that in the prior year, your production costs are not 46 Rand and 32 cents, but instead, let's say in the prior year, your product costs are 45 Rand per unit, okay? So last year it was 45 Rand per unit, and this year it increased to 46 Rand and 32 cents per unit. Now you can see there's a problem. And the problem that we are dealing with over here is because opening inventory is valued at 45 Rand per unit and not 46 Rand and 32 cents. There's been a change in our production costs from the prior year to the current year. And then you can't use this shortcut where you say cost of sales divided by budgeted sales, because now you don't get the same answer. You can see these amounts over here are different. If I just highlight these. Okay, over here we have a very small difference because I don't have a very big difference in the cost. So it's a very small difference, but you can see it's different. It's not the same. So it's important to note, and you'll see this in your notes, guys, you can only take this shortcut where you say cost of sales divided by budgeted sales. You can use this shortcut if there are no units in opening inventory, because then obviously you don't need to worry about any change in production cost because there is no opening inventory. You can also use this shortcut if there has been no change in production costs from last year to this year, because if there's been no change in your production costs from last year to this year, you can see your answer is 46 Rand and 32 cents. However, if there's been a change in product costs, let's assume last year that product costs were 35 Rand per unit, then you can see you can't use the shortcut because you are then getting an answer of 45 Rand and 78 cents, and that's incorrect. That is not the current year product cost. The current year product cost is 46 Rand and 32 cents. All right, so that's just to help you with your understanding. I've just covered the explanation that is in your lecture notes. Let's go back to this question. Then lastly, we just need to deduct variable marketing and admin costs. All right, and this is a simple enough calculation, guys, because you'll remember in note 3, you were told that variable marketing and admin costs are 2% of sales. So the easiest way to perform the calculation is to take the selling price per unit for each product and multiply by 2%, and that will then give you the variable marketing and admin costs per unit. So once again, I'm just going to quickly jump to the suggested solution over here because this is a very simple calculation. In calculation 7, there's the variable marketing and admin costs. That's the selling price per unit for each product multiplied by 2%. Right, so that's calculation 7. For jam, it is 1 Rand 20 per unit, and for chutney, it is 80 cents per unit. All right, so sales minus all of the variable costs will give us contribution per unit for each product. right, and then because the company sells two different products, we need to calculate a weighted contribution per unit. And remember, you calculate the weighted contribution per unit by using the sales mix. So please, you must look at budgeted sales and not budgeted production when you are performing this calculation. So once again, guys, very simple. So I'm just going to quickly jump to the suggested solution just to save a bit of your time over here. So budgeted sales for jam is 39,600 units, and for chutney, we calculated it to be 20,700 units. So in total, budgeted sales are 60,300 units. So what you do is you take the contribution per unit for jam and you multiply by 39,600 and divide by 60,300. And then for chutney, you take your contribution per unit and you multiply by 20,700 units and divide by 60,300 units. Add those together in order to get the weighted contribution per unit. So the weighted contribution is 20 Rand and 50 cents. So let's wrap up this calculation. And that's from calculation 2. All right, so that's going to give you an answer of 61,098 units. Remember, guys, you always need to round up to the nearest whole number. If you round down, then the company won't break even, they'll make a small loss. So please make sure that you round up over here. Now let's just make sure we've actually answered the required. You had to re-perform the break-even point calculation. So we calculated the break-even points in units. And if you did perform the calculation correctly, it should tie into the break-even that you were given in the question. Because you were told that Jane correctly calculated that the business needs to sell 61,098 units to break even in the first year. So we've answered then part A1 of the required.